Welcome to this recap of the year gone by, outlook for the year ahead and a portfolio update. The S&P 500 is up plus 22% this year, after a negative return of minus 19.4% in 2022. U.S. equities continue to outperform global markets. S&P 500 companies' earnings are expected to be flat this year compared to 2022. Retail interest, hedge funds and corporate buybacks led by stocks in the information technology, communication, financial and energy sectors continue to keep U.S. equities as a buy on dip since 2020. The wide gap between the CPI, Fed rates and the 10-year yield has reduced in 2023. The Fed seem a lot more in control of the rates this year than in 2022. Inflation in PCE, a measure that is followed by the Fed, has fallen to 3% YOY in October 2023 from a peak of 7% in June 2022. Inflation in energy prices, goods and services, which was the largest contributor to inflation last year, is pulling it lower this year. US GDP has risen from $19 trillion in 2017 to $27 trillion currently. A large component of the GDP is the personal consumption expenditure, PCE. PCE continues to rise, despite increases in interest rates, raising expectations of a soft landing of the economy by the Fed. Savings rate rose to record highs of 15.4% of disposable income in 2020, far above the long-term average of 5.2%. Post-U.S. reopening, these high savings rates depleted into consumer spending, PCE, and kept the consumption growth rates above its long-term average of 4% in 2021, at 12.9%, 2022, at 9.2%, and 2023, at 5.7%. While disposable income did not grow in 2022 and fears of recession made headlines, these above-average consumption rates kept a U.S. recession away in 2022 and 2023. In current dollars, PCE is growing at 5.7% in 2023, compared to 2022. Spending in durable and non-durable goods continued through the pandemic and the reopening. Spending in services stalled in 2020 and is catching up post the U.S. reopening. According to the forecast published at the FOMC meeting on December 14, 2023, participants project the appropriate U.S. Fed fund rate to be at 4.6% at the end of 2024 and 3.5% at the end of 2025. According to various analysts, the S&P 500 index is expected to end 2024 anywhere between plus 8% to minus 8% from its current level. According to a recent report by Statista, the U.S. GDP is expected to grow to $39 trillion in the next 10 years. This is an expected GDP growth of 3.4% per annum. According to industry analyst estimates, the earnings per share of the S&P 500 is expected to grow by 11% in 2024 and 12% in 2025. The index is currently trading at a 21 PE ratio, trailing 4 quarters, and a 19.4 PE ratio, forward 4 quarters. The Magnificent Seven. Apart from Amazon, which is currently at a market cap of 2.7x its annual revenue, the remaining 6 stocks are between 5.5x to 26x their annual revenues. Despite being perceived as overvalued compared to its peers, these stocks have beaten the index performance in the last 5 years, seen in the 5-year beta. Analysts continue to raise their upside targets on these stocks. Key risks. 1. Fall in consumption. With savings rates in the U.S. back to its long-term levels, rise in PCE will require increase in real wages. A second risk. Interest rates remain elevated. If real wages and PCE continue to support consumption, this may add to inflationary pressures, keeping interest rates higher for longer. And third, can the Fed manage a soft landing of the economy with below-average growth in GDP? We continue to track and assess economic data from the U.S. and actively manage the investment portfolio. Now it's time for the portfolio update. We began this series with a portfolio framework and construction based on fundamental research. You can read all about it on our website or check out the previous videos. In terms of portfolio allocation, long holdings have 29% in equities, 23% in fixed income and 48% in cash. Short holdings has just one equity position. Geographical allocation: 53% in the US, 39% Europe and underweight China with a 6% exposure. Portfolio performance. The long holdings has generated a return of 7.6% this year and a dividend plus coupon yield of £23,287 or 1.79%. The top gainers in the portfolio are Tesla at plus 57%, United States Steel at plus 52%, Alphabet at plus 37%, Emerson at plus 10%, and Glencore at plus 9%. Derivative trades, calls and puts, with Nvidia as the underlying generated £15,000 in gains. Transactions. Adding to Deutsche Bank, reducing exposure to AP Moller, exits from ICBC and Swire Properties worked well in favor of the portfolio. The exit from 9618 HK, JD, could have waited until the bounce up from October. Also, profit booking in Tesla was early. The short portfolio has fallen minus 32% since the trade has gone against us, with Nvidia rallying despite its overvaluation. Overall, the portfolio is down minus 26% this year and possibly requires a new strategy to recover the losses and get back into the green. More of this in January 2024. Thanks for watching. See you soon.